What can we expect? We can expect more bank failures. We can expect huge write-downs on Wall Street. We can expect banks in America will be selling off huge assets in order to survive. We can expect more government bailout proposals that have no real substance, smoke and mirrors, tell them what you want, tell them what they want to hear, propaganda. We can expect the Fed will push short interest rates down to 2% by mid-2008 and flood the system with trillions of dollars in liquidity, which will be very inflationary. We can expect a U.S. and global economy in recession, more market manipulation in all markets, and possibly global financial collapse triggered by an implosion in the derivatives market. Much more likely, a U.S. financial collapse and/or inflationary depression triggered in the derivatives market. We can expect the government and the Fed bailout schemes will deepen and lengthen the depression, just as during the Great Depression in the 1930s it did the same, and monetary policy in Japan did the same for 15 years between 1989 and 2004. The coming collapse of the modern banking system. This is a very, very important quote. Morgan Stanley's Asian chairman, Stephen Roach, wrote an article in the New York Times, an article titled "The Coming Collapse of the Modern Banking System." In it he said, I quote, "This recession will be deeper than the shallow contraction earlier in this decade. The dot-com-led downturn was set off by a collapse in business capital spending, which at its peak in 2000 accounted for only 13% of the country's gross domestic product. The current recession is all about the coming capitulation of the American consumer, whose spending now accounts for a record 72% of GDP. Most people have no idea how grave the present situation is or the disaster the country will face if trillions of dollars of over-leveraged bonds and equities begin to unwind. There's a widespread belief that the stewards of the system, Bernanke and Paulson, can somehow steer the economy through this rough patch into calm waters. But they cannot, and the presumption shows a basic misunderstanding of how markets work. The Fed has no magical powers and will not allow itself to be crushed by standing in the path of a market avalanche. As foreclosures and bankruptcies increase, stocks will crash and the Fed will step aside to safety. Bill Gross, the U.S. largest bond fund manager out of California, has said we're witnessing the destruction of the modern banking system. The objective reality is that banks don't have the reserves to cover their downgraded assets. They don't have enough reserves to cover their downgraded assets. And the Federal Reserve cannot simply monetize those hundreds of billions or trillions of dollars in bad debts. There is a limit. And if you don't set limits, you end up with Weimar Germany. There's no way out of the coming great pain, and we think that there is a lot that you can do to be preparing. We'll cover that in the final remarks. The greed and mendacity of the Wall Street big bank executives. Let's ask a question. How did and can a big bank or Wall Street executive make 30, 70, even $150 million in annual bonuses, including stock options, as many recently have in these recent years? The answer is by presiding over the creation of a multi-trillion-dollar, highly leveraged debt bubble, the greatest Ponzi scheme in world financial history, now totaling $681 trillion. The greed, arrogance, dishonesty, deception, and manipulation in our banking and securities industry is off the charts. It's never been greater. These irresponsible financial leaders, with the assistance and blessing of government regulators and rating agencies, as we've already seen, have set the stage for what could morph into the greatest financial debacle in world history. As the financial dominoes fall, they will plead innocent, of course, and beg for public taxpayer bailouts to save their institutions, to save their jobs, to save their multi-million-dollar bonuses. So they made money in good times, and yet in 2007, while Wall Street brokerage firms lost $76 billion, their top managers paid themselves $34 billion in bonuses. It does not go both ways. The bigger they are, the harder they fall. The giants are in trouble. The big giant banks and securities firms in America and in Europe, through this subprime mortgage fiasco, have orchestrated massive off-the-chart speculation, a multi-trillion-dollar bet in the derivatives market, in many cases, flat-out flagrant fraud, deception, and manipulation, all of which is about to trigger an avalanche of lawsuits against them. The giant investment banks that floated the majority of these structured packages, packaged mortgages include, but aren't limited to, Citigroup, Bank of America, J.P. Morgan Chase, Morgan Stanley, Merrill Lynch, Lehman Brothers, Goldman Sachs, Wells Fargo, Bear Stearns, Wachovia, Washington Mutual, Fannie Mae, Freddie Mac, Blackstone Group, and all of the other private equity firms. Now, the Fed is now looking at gridlock, their greatest nightmare. The Fed is terrified that the U.S. consumer, which accounts for 72% of U.S. economic activity, will become frightened and pull in their horns and stop buying and borrowing. So they're giving the American consumer $150 billion to help ease the pain. Will it go to pay debts? The government certainly hopes it won't. They hope it goes to a new TV set, a new VCR, a new gizmo, a gadget, a vacation to Disney. They need it to go into the system and create more and additional activity, economic activity. The Fed is terrified that banks will become frightened, pull in their horns, and stop lending. And at that point, the economic system begins to contract rapidly. We see what we already have begun to see, reverse leverage. Economic activity grinds to a halt, then goes into reverse, contracts, and a deflationary recession or depression begins to take hold, like the one that held Japan in its grip for 15 years. The Fed is terrified that these two nightmares will become a reality, and indeed, they are both now beginning. A credit crunch and gridlock are approaching, and a complete implosion in the multi-trillion-dollar debt pyramid.